I am so excited. We have Sheel Mohnot today online with us. The last time I think I saw you, Sheel, was about 10 years ago when we were fighting to win an auction for .club. .club is an alternative to .com, .net, .org. And that domain extension went up for auction, and Sheel had managed the auction process for us. And we ended up winning that company. We raised $12 million. We did a private placement memorandum and a Reg D filing. We did not go down sort of the VC route. But today we're talking about just that. We're talking about seed funding. And the first question I have for you, Sheel, first of all, please introduce yourself for 30 seconds, maybe a minute. And then let's just, my first question for you is, like, I'm confused. There's pre-seed funding, seed funding, Series A, B, C, and D, and then IPO. I mean, can you just tell us a little bit about when a startup needs to raise money, at what stage should they be looking for each of those?
Sure. Hey guys, Colin, it's great to be reconnected with you. So, quick background on me: I started a venture capital fund a few years ago called Better Tomorrow Ventures. We are a fintech focused fund, typically investing at pre-seed and seed. Prior to that, I'd been investing. I had another fund, and before that, I was investing my own capital. And before that, as you know, I ran an auction business, which is when you and I first met. And prior to that, I was an entrepreneur running helping run a payments company. And that company was acquired in 2012. Um, at our fund, BTV, we currently are investing out of a total of a $225 million fund, and typically, as I said, leading pre-seed and seed rounds of fintech companies. Now, your question about when should you raise money uh, and at what stages? Typically, if you are building what is or should be a venture scale business, and that typically means a business that we think has the potential to be a $1 billion plus outcome. Um, if you're building a business like that that requires capital to scale, and it requires capital to get off the ground and get to a point where ultimately at some point in the future there will be profitability, then venture capital might be the right path. And the way to do it is to go through your network and get introduced to pre-seed or seed investors like myself, investing in the category that makes sense to you. And as things go on, typically, historically, it's been something like every 18 months or every 12 to 18 months, you go out for a new round of funding. And that's where we said the seed A, B, C, D, etc. And then at some point, eventually, in an ideal world, you are at a scale at which it makes sense to go IPO and be in the public markets.
Or exit, right? I mean, that's the other
That's what you
alternative.
did, right? Uh,
Right, to end the story from the .club days when I first met you, we actually ended up selling to GoDaddy last year, and it was it's good timing, given where the world's at right now. Um, that's another. We're going to open it up, and if you're in the audience and you want to ask Sheila a question, please raise your hand. This is what it is. It's an open conversation, and we really want to make it interactive. Uh, so my next question to you is, given the current environment, I mean, Sequoia 2 days ago came out with a memo that basically, startups to cut costs or face a death spiral. And it was like a little bit of a shock, hearing about this because we're seeing the public markets get hammered, but we often don't hear a lot about the window for startups to raise money. Is that window closing or is there still opportunity for startups?
yeah, it's gotten a lot harder. And the main thing that is related to this is interest rates. If interest rates are very low, that means that you can you're basically buying growth instead of profitability, because if interest rates are low, then you're willing to value something at what it's worth way in the future. And when interest rates rise, which they have been doing and are going to continue to do this year, um, you tend to value profitability more. So what that means is if you look at all the companies out there, the most unprofitable ones are these venture-backed startups. So that means times get a little bit tougher. I think in terms of like what we're seeing in the market, things definitely are changing. It's gotten a lot harder for folks to raise that Series A, B, C, D rounds. A lot of folks are raising less money than they expected, and there's a trickle down effect from that. If you wanted to raise we had the case, one of my companies, we wanted to raise a $250 million round. We ended up at less than half that. And in that case, what you're doing is cutting costs. So we have to cut costs. And guess what? A lot of our vendors are other startups. So they're going to face the pain as well. So there is a trickle down effect of this. And I think it's going to be a tough time in the startup market for a little while.
Yeah, I know in my particular case, I just completed a investments about a week and a half ago, and I said, okay, that's my last one, because I have to look back at I've got about 15 companies in my portfolio, and it's a family business. I'm in a family office. It's not VC, but quite frankly, a lot of them are struggling, and that means I may have to continue to fund these companies. I don't want them to go under. So I may have to continue to fund them, and that takes money away from potentially from new startups who are coming in the marketplace.
Absolutely right. And it's the same thing for us. And, in many cases, we are reinvesting capital into our existing portfolio there are some good ones out there that have just struggled to raise a little bit. And so we're giving a little bit more runway.
Great. Do we have any other questions from the panelists? And then we can start to bring some of our great audience onto the stage and ask questions about this topic. Jeff?
Yeah, I was just curious. First of all, Sheel, great to hear you. I was going to say see you, but I can only see your animated
Yeah.
character. I still relish in the wonderful vegan sushi meal we had together a few years
That was
ago.
great.
Uh, but I'm curious because you're very focused on fintech, and I think in this kind of tricky economic time, do fintech startups see a different position than just general startups? Like, is there more pressure on things trying to be innovative in the financial markets since it's a weak market right now?
Yeah, we're seeing, I think the effects are yet to be felt. I think there definitely are different types of businesses that'll get funded in this environment than others. An example would be, one of our companies, one of the companies I invested in is called Mercury. It's a bank for startups. Great one, by the way. If you're starting a startup and are looking for a banking partner, use Mercury, mercury.com. But what has changed for them in the environment is um, they're sitting on a bunch of deposits. And for the longest time, they made no money on these deposits. But now, with the interest rates going up, all of a sudden they're making a bunch of money on these deposits they're sitting on. And I think that means, their business model is fundamentally different now in this higher interest rate environment. And I think there are a bunch of other companies for which that'll be true as well. And we'll see a lot more innovation in these kinds of businesses.
Interesting. Different effects for different companies. Thanks.
Hi, Shell. This is Michele. I have a question. We have a lot of members here at the Startup Club that really are at early stages of their startup. So I'm wondering if you could give us a little bit more insight into, what a VC such as yourself are looking for. Like, what stage, like what would I need to have in place before you'd even like really have a semi-serious conversation with me? What would I need to be able to prove to you?
Yeah, I would say, it's not necessarily one thing. There's a bunch of things. I would say the things that we look for are, number one, the team. Is this a team that people can get behind? And are they able to very clearly articulate their vision? It's That's, I think, like probably the thing we look for most. And that clear articulation of the vision means that you're typically a good salesperson. You have to sell us on investing in you. You have to sell your future customers on investing in you. You have to sell your future employees on joining you, and you have to sell potentially future investors on continuing to fund the company. So a clear articulation of vision, I think, is very important. So that's team. I think we look for technology companies that have a significant advantage. We look for traction of some sort. It may not be traction in terms of revenue. It may be other forms of traction. In fintech, there's often some regulatory hurdle you have to get over, or some partnerships. Um, and uh, and then we want to make sure that the terms make sense for us. And then, of course, at the back of all of this, we're always looking for businesses that we think will be profitable and generate significant profits in the distant future.
But what pops? Like, so when you receive like 50 requests to have a meeting or for someone to make a pitch, is there something that someone can do? Should the color of the font be green, or is there some trick that pulls you in? Is it how authentic? I don't know. I mean, I'm not a VC. I've been pretty critical in my past around VCs, although I've used VCs for some of my companies. But what's the trick? What is it that can get you in the door?
Yeah, I think it's much more about the story that you tell than anything else. Of course, you want a deck that looks nice and all that kind of stuff, but it's really about authentically telling a compelling story that is something. Also, it has to be something I'm interested in. Like, there are a lot of great businesses out there that I just don't care about, and so there's really no good way to know that. You know, anyone that you're pitching, you should try to get to know in some ways, but there's no way that you're going to know everything that I'm interested in and things that I'm not. But there's certainly very good businesses out there that just don't interest me by any means.
Yeah, we talked about that on a prior show about, basically knocking your head against the wall when it comes to trying to raise money from particular investors if they're just not in your space. And I used the example of my IPO when we went public in 2006, and it was a Canadian company, but we did an S1 in the US. And I had 30 some odd meetings in Canada, and I had 6 in the United States. I managed to close 3 institutions in the United States and 3 in Canada. So clearly, I was pitching to oil and gas companies that didn't really care about tech. And then when I went to the US, I was able to find the right investors. So, I think that's one of the things that I learned from that experience. And what you just reiterated today is that we really need, when we're trying to raise money, try to find the right type of investors. And I think if you can do that, that's half the battle.
Yeah, that's absolutely right. Is that story from Two Cows?
That was Hostopia, actually. Two Cows was from
Hostopia. Okay,
Two Cows we never took public. That one went public after I had sold it. Elliot Noss still runs
got
it
it.
today. Yeah, but that was an interesting story. But well, let's not digress. Let's not go back into the 90s, Sheel. Let's stay here in the
I'm
2020s.
so interested in learning about you. I don't know. All right.
All right, we have Ed. You're on stage. I don't know if Ed, you have a comment on this topic. I know you started Startup Club, Ed, with this vision of an ecosystem, including startups, but also the investors and VCs and angel investors. Ed, if you're there, did you want to
Uh,
add anything?
Ed and I go way back to the early days of Clubhouse. We met, I think we both started on Clubhouse around the same time and had many late nights in here with a group of other folks talking about silly stuff. So this brings me
Oh
back.
yeah, such awesome memories from that era from long ago. What, 2 years ago? But good to hear your voice and good to check your profile out and relive some memories of the video and PTR games and all that stuff. But the more serious question is, you kind of danced around it. What is it that you are looking for these days? What is the ideal startup opportunity you're looking for? So maybe that someone in the room is that opportunity that if they know more what you're looking for, maybe we can make that connection.
Yeah, sure. It's interesting. I wouldn't say there's a particular thing I'm looking for. There are investors that are thesis driven and investors that are opportunistic. Investors, and of course, there's a hybrid. Some investors are, you know, thesis driven, and that they have an idea of how they want the world to look, and they want to fund companies that are build that. And so they might have a specific idea. I'm looking for a bank that serves the gay population in America. And I'm just going to look for companies that are doing that. And then there are others who are opportunistic. The opportunistic ones are folks that just see what comes in front of them and picks the best one. And I fit into that latter category where I am just looking for, folks pitch me all the time, and I'm just looking to be compelled by the pitch, not necessarily looking for it to fit something that I'm already looking for.
And within that, a lot of different investors will take different types of risk. Where you like more looking for like technology, the team, the market opportunity, or what kind of combination are the things that you go, wow, that make you stand up and really take notice?
Yeah, I think it's a combination of the above. I would say more team focus than anything else, but it's really a combination of all of them.
And since Colin already said he didn't want to revisit the '90s, let's revisit the '90s a little bit because you were both in the ecosystem of the early like .com alternate, the the alternate domain name registry extensions. I got the terms messed up. What was that process like? You know, because you were seeing different aspects of. You saw part of it, Sheel, I guess, from the auction side. Colin was actually creating one of the domain extension. Uh, what was that like from your end? What did you see back then? And is there anything that, any lessons learned from that era?
So I was not early like Colin. I was a latecomer to the business. We started out in 2012, so there was the domain extensions when ICANN, which Internet Corporation for Assigning Names and Numbers, decided to add new top level domains, and Colin had the foresight to apply for .club. And I met Colin and Jeff early in their journey, but not that early. They had already applied and gone through the process, and then there were multiple competitors for .club, and Colin and Jeff, participated in our first auction. So we were a baby company, and they put a lot of trust into us because they had to send us, millions of dollars, and that was in 2013. Was it? If I remember correctly, Colin, was it June 2013?
June of 2013. Yep, exactly.
That's right. Yeah, and they really put us in business. I think we had an auction for 8 names at that time, June of 2013, and we ultimately ended up doing something like 150, 170 names, and it ended up being a great business. But these guys were some of our the first folks to take a chance on us.
Yeah, and the backstory to that was that 30 days prior to the auction, we actually had to raise $7 million. And we did that using my LinkedIn contacts, a private placement memorandum, and a Reg D filing. So it goes to show you there are alternatives to VC funding out there. And so I didn't think I was going to go down this path, and I'm not looking for a spar here either. Again, I do believe the VCs are there's the right situation for the right company. A VC makes sense. Are there examples where it doesn't make sense, Sheel?
Absolutely. And for the vast majority of people, VC funding makes no sense whatsoever. You should not sell a portion of your company to somebody else because you can build it yourself and own all of it. So, an example for me is we had my first company was a VC funded, and at the end of the day, when the company got acquired in 2012, um, we had, first of all, an insane amount of legal fees, and second of all, I was looking at the total figure that was supposed to be, the company I sold, and then what I ended up getting was a small fraction of that, and that's because we had venture capitalists and a bunch of other shareholders involved in the business. And then another company I started and sold had no venture capitalists, and it was pretty amazing to, when we sold the company, our legal fees were very minimal. Number of shareholders were few, and then we got me and my partners got all the money. So that was pretty great. Now, that was a business that didn't require a ton of money up front, and we were able to front it ourselves. I think for some reason, there's this like sex appeal of raising venture capital money that I think is actually foolish. I think the largest number of companies would be better off without raising money or without raising much money. It's become this sort of like venture capital treadmill where you raise the money and then you kind of are forced to spend it. And then uh, you spend the money and you have to grow more. And you may end up doing some unsustainable things, at least in the short term. And what we try to tell our founders to do is not do those unsustainable things in the long term. So when you get started in venture capital, let's say you have a consumer business, you want to have a payback period from your initial outlay to acquire a customer of when you get your money back, and you want that, depending on the business and how long the customer lasts, you want it to be less than a year if it's a customer that's going to last for several years, or if it's a customer that's only going to last for less than a year, you want it to be much shorter. But oftentimes with venture capital money, people have the idea that they should just grow as much as possible and end up doing unsustainable things. And what ends up happening is a lot of the venture capital money ends up going to pay Facebook and Google for ads. And I think, probably over the course of the next 6 to 12 months, a lot of this is going to change. And some of the unsustainable stuff is going to go away. And of course, at some point, it'll come back again.
Yeah, and I think one of the negatives of venture capital, and this could also be in other forms of, it's not just venture capital, but there's a concept called liquidation preference. I'm working with a company right now where the founder spent 14 years working in the company. They raised $60 million of venture capital. The company still exists today. I won't say the name to protect the identity of the individuals behind it. But I was asked to step in to try to help them do a turnaround. It's a tech company, but my estimation is the company's worth no more than 10 to 20 million at this stage, and yet they had raised 60 million. And that original founder, not only was he replaced as CEO, his ownership is worthless essentially. So, when entrepreneurs go down that venture capital route, it is something out of the movies. I have a friend who was working with I think it was 500 startups. Lil Roberts with Zendu. She's been on the show, and you know, I she came back from that little incubator after 6 weeks or 8 weeks, the way she was talking. I said, you know what, you got Silicon Valley disease, right? I mean, it's some of these companies get carried away, and there's a lot of Silicon Valley carnage out there. Yet we think that if you get a VC, you won the lottery.
Yeah, definitely true. I couldn't agree more. So a lot of times, I tell folks that are pitching me, hey, you ought to consider not raising money. It usually doesn't land that well, to be honest, because people have an idea of what they want to do, and sometimes it's hard to dissuade them.
Now we're going to jump you to Jeremiah in a second, but I feel like we're on a flow here. Now just flip that. You could take a Clubhouse, and I know you were involved in the early stages with Clubhouse. Here's a company that's got fierce competitors, Twitter Spaces,
Twitter, yeah.
Spotify. It's like if they don't move fast, that's what Hostopia had a VC too. We had to move fast. And for those tech companies that need to move fast and gain market share and establish a standard, in the case of Hostopia, global, in the case of Clubhouse, a global standard. If you're a winner take all market, VC makes a lot of sense. And I don't know how familiar you are with Clubhouse, and if you could talk at all about that, or if it's I think it's pretty much public, but let me know.
Yeah, Colin, I mean, you completely nailed it. If you're in a winner take all market, it makes sense to just grab as much market as you can as quickly as you can, because the fact that you're the winner is going to be worth a lot. So, let's use Twitter as an example. Any network effects business. If you let's say Twitter, if you were starting a competitor to Twitter today, you'd have to get. I guess Trump has one, but I have no idea who uses it or whatever. But um, you'd have to get a ton of users on board, and people would be reluctant to use it because there aren't any users. The chicken egg game. So um, the nice thing, so what happens is like you're in a race to get as many users on board. Then once you have those users, there'll be more users because people want to see what Colin posted, and the same is true of Clubhouse. The more users you have, the more people want to come and listen to folks, smart folks like yourselves talking. And that's the game that they're in. Now, I think you're absolutely right. Twitter Spaces, I think, has become a very formidable opponent. And I think a lot of the conversations that would have been happening on Clubhouse are happening on Twitter Spaces. And part of the reason is people are already on Twitter Spaces. Even though Clubhouse had a tremendous rise a year or 2 years ago, there are a lot more people on Twitter, and it's a lot easier if you're already on Twitter to just join a Spaces room there. I actually, frankly, was surprised and impressed by Twitter that they were able to launch that product so quickly. I had not seen a ton of innovation from Twitter in the previous years. I'm one of the guys that's still waiting for an edit button. But yeah, that's I think Clubhouse has a lot to figure out yet. But they have an amazing team, and I think some of the brightest product minds I've ever seen. So I'm sure there's a lot of good stuff to come here.
That's great. And if you're in the audience and you want to get on stage and ask a question of Sheel, I mean, this is a rare opportunity to get him on stage, and we really appreciate your time, Sheel. Also, if you'd like to share the room, and even if if you like what you heard, share the room. It's a little icon down at the bottom there with the up arrow. If you click on that, you can share the room on Clubhouse and also on your social media as well. And it is also available in replay. And again, as I mentioned at the beginning, this is now a podcast. So if you search your favorite podcast channel, whether it's Apple or Spotify or iTunes or TuneIn, search for Serial Entrepreneur Club, and that will pop up. Jeremiah, you're on stage. Do you have a question or a thought about this topic?
Hey, thank you very much for having me. Jeffrey, in particular, great to see you again. I was in the room with you very recently. Colin as well. Sheel, thank you so much for all your wisdom so far. Michele and Ed as well. So my name is Jeremiah Schwartz. I'll give you a quick rundown of what we do and not try not to get into the weeds too much. And not waste anyone's time, hopefully, because we're not necessarily interested in VC, but I wanted to hear your opinions on this and if there's a future opportunity for VC based on what we're doing. So I operate and created an emerging sport called Tri-Ball. We really do believe that this is the sport for the future generations. We are focused on creating the world's #1 mixed gender competition. We are leading business development and leaving that product development phase, having traveled the world for 17 years and getting about 65,000 participants to actually play the game. So now we're trying to build it into a sport so we can generate revenue, be self-sufficient, and reinvest into resources such as inventory of balls and goals, and then sell it with economies of scale. Therefore, it's more affordable for schools and backyard equipment, et cetera, et cetera. The way we plan to lead business development is through our Tri-Ball Championship. It's a U.S. national tournament. Now, we are in sports. Typically, I don't see many examples of VCs in the sport industry or interested in sport at all, with the exception of maybe 5, and they're very, very competitive to get into. One of my questions, however, was I've been considering recently not only doing regulation CF, equity crowd investing, but I think if we were to launch that for the tournament, yeah, it could be great, but we're probably not going to sell it out at any point in time, anytime soon. However, teams, and if we look at the business model of most teams, a lot of people try and build the teams up to a point and then resell them for a higher value. So I was wondering if anyone found it somewhat possible where we start building the tournament and then we start also allowing VCs to invest into teams that we would co-own with them. Does that make sense?
Yeah, I haven't seen a whole lot of venture capital investment in sports. There were a bunch of emerging sports leagues that did have investors. IPL in India, the Indian Premier League of Cricket, is one that has done phenomenally well recently. I think it's about 15 years old. Um, there were other fields where VCs did invest. There's one called the Drone Racing League. I don't know if it's still around anymore. Um,
Yep, absolutely.
um, and then, sort of more recently, a friend was just telling me yesterday, pickleball has gotten a ton of attention, and they are selling pickleball teams right now, and some relatively famous folks have got bought them, including Gary Vee. I think they cost $500,000 each. I didn't look into the particulars, but somebody sent me the deck at some point. Um, so yeah, I think I think there is interest in sports. I do think it's probably going to be hard if you only have ever had 65,000 people playing it. Like, I think sports need a groundswell of people playing it before you could probably monetize it. Um, that's my hunch. Is you're going to need a lot more people playing it. I think there are tens of millions of people playing pickleball actually regularly, which the numbers surprised me. Um, and I think they're now in a good position where they can sell teams, and maybe some of the team revenue that they sell goes back to the parent entity, which is a model that you could probably go after as well.
I, can you hear me?
Yep.
Okay, yeah, and thank you for that. I hear that a lot, and I agree that 65,000 is not a number worth boasting. Even though building a sport, it's not like an app or any consumer business. Obviously, you know this. It requires a decent amount of people to play in each game, and then the actual cost. Anyway, that being said, what I find interesting though is if we look at the actual history of a lot of team sports, they actually were developed the exact opposite. It wasn't through participation. It was actually through the entertainment spectacle. For example, football, American football, when it was growing out of rugby, in one of the first 5 games, official games ever played, and let's remember that there's probably only about 100 footballs ever made at the time. God forbid one popped, you'd have to wait a year to get another one. But these were run by clubs at the elite level colleges. So Rutgers played Princeton, and maybe 50 people were on the field, but 100,000 people came to watch. And that's what actually started to cultivate the participation. So that's one of the things that we're trying to circumvent. We want to lead with a televised and straight to digital entertainment platform that would then incentivize, educate the market, and bring the market in specific areas where we see where they are, who they are, why they want to be involved in a manner that we can better control and distribute as far as participation. But it does
That's
seem
cool.
it seems
So
very evident right now that ESPN, for example, wants content. So that was our
no,
idea, at
it's
least.
it sounds cool, and I will say this again, it's about finding the right potential investors and doing your homework and figuring out what kind of companies would invest in that. I will say that we went to Venture Atlanta with paw.com and we presented there. Even though it was an e-commerce company and it was scale, it was over 40 million in revenue. We still had we got a bit of a cold shoulder, I have to say. And that's because they all seem to be focused on this. They love digital platforms. They love recurring revenue. There almost seems to be like a playbook the VCs And this could change too, by the way, because this is where it was 2 years ago. These cloud computing stocks that had, accretive monthly revenues, MRRs, and had, growth rates of, huge growth rates and then you track the churn rate and low churn and all that stuff. Is that correct, Sheila? Am I wrong about that? But it just seems to me the VCs were just focused on these digital platforms with recurring revenue.
Yeah, I think there's a lot of interest in recurring revenue, um, more so than e-commerce. Although you just have to find the right investor. There's a right investor for every different type of business, and you just have to find the right ones and convince them that of what you're doing.
Yeah. I wanted to just add too, because Jeremiah, you made me think of it too. Both Colin, you and Shield mentioned, that there are other ways to raise money, and sometimes venture capital is not the right way. One thing that's often very useful for a startup is a strategic investment, right? Finding money, and it could still be structured like a VC deal, so you want to be careful about that. But there are opportunities to raise money that's strategic. So, for example, when I was a co-founder of barpoint.com, we were focused on the barcode scanning space back in 1999. And our first investor, we raised $3 million from Symbol Technologies, which was the leading manufacturer of barcode scanning hardware. So there was a strategic fit that attracted them to what we were doing, even though we were an unproven startup. So I think in the sports arena, especially at this early stage, there may be more opportunities to raise money from a strategic partner as opposed to a traditional venture capitalist.
For sure, I think that makes a lot of sense for some businesses, um, and there are definitely synergies you can get there. I will say, oftentimes having a corporate partner makes it harder to get a venture capitalist like myself on board. And the reason for that is the corporate partner, I don't know what the case was with Symbol and Barpoint, but like the corporate partner may see it as a path to acquisition. And it could be a low dollar acquisition, generally speaking. And that's generally not something that VCs want. Acquisitions are nice when they have a huge price tag, but oftentimes, uh, you know, a strategic investment means that somebody would be interested in buying it at a lower price in the, let's say, tens of millions of dollars, which wouldn't return much money to the VC fund. So something to think about in terms of what VCs are looking for. But
Yeah, no,
certainly for the entrepreneur, it can
good
make
point,
a lot of
Sheila.
sense.
Good point, Sheila. In the case of Barpoint, we were fortunate. We eventually went public and then did a pipe with Jeffries and Company thereafter. So
Amazing.
Symbol was a small piece of that pie ultimately. But you're right. It's something that we actually kind of hoped they were thinking of acquiring us when we went into that deal.
Cool.
All right, we have another Stephen on board up. You're up next, Stephen. We can't see your face, but we see your start button.
Hey, thank you for having me on stage. And I want to thank the moderators for bringing in Sheel and Ed. Really great work in doing that. I shared it on Twitter, and it's very rare to have people like Sheel and Ed on. So Jeff and Colin and Michele, thank you for doing this. My question for anybody up on stage, Sheel, Ed, or anybody up there, is when you're looking at startups, from your view, you hear people like out of the PayPal mafia, they talk about first principle thinking and first principle thinking, you hear everybody from like Reid Hoffman, who put together LinkedIn, to, even Elon Musk, and you hear about first principle thinking. And I'd love to hear any thoughts you guys have on startups that use it effectively, or is it talked about a lot? And from the VC side or from the founder side, do you guys talk about first principle thinking where you're trying to get to see how they decide whether something's true, maybe their theory of constraints on how they make decisions of what to do, what not to do? I'd love to hear any thoughts you guys have, because it's very fascinating to me, but I don't hear it talked about very often. And but I'd love to hear people's thoughts that are on this stage, because this is not a typical startup stage. So thank you for doing this, Colin, Jeffrey, and Michele, putting this together. Sheel and Ed, thank you for being here, for brilliant things about everybody up on this stage. Thank you so much. I'm just going to listen.
Do we have someone on stage who can address first principle? I have some thoughts, but not, it's
Why don't you kick
slightly
us off,
different.
Colin?
No, yeah, it's like, look, I'm not a student of first principle, that what you talked about there, but I will say that, every one of my companies since 2006, we do strategic planning, and we spend 2 days offsite. I say 2 days of 2 days of strategic planning, 88 days of execution. And more often than not, we always have those aha moments. We come across these times, these ideas that just seem like you never would have done it had you not had this formalized, structured, strategic planning. And we come up with them, we execute on them, we implement them, and the results show by the success of the company and the sales and stuff like that. But that's just something that we've done in the past. Anyone have experience with what's called the first principles? Can you say that again, Stephen? First
Yeah.
principle thinking?
Yeah, first principle thinking. So where I've seen it the most common in first principle thinking is people that have come out of Stanford and have been in like the philosophy department, like people like say Peter Thiel. Like if you read like 0 to 1 Peter Thiel, that goes through a lot of first principle thinking. Or if you go through, you listen to Reid Hoffman, he'll talk about first principle thinking. Elon Musk, well, like if you Google, first principle thinking, I think Elon Musk is like the first one, but it's deciding whether something's genuinely true or not true. Because I think that's why people like Peter Thiel. I think he hired like Eric Weinstein, who's really really smart in like physics and philosophy. Because I think philosophy has its roots. Like if you look up the Encyclopedia of Philosophy, it's out of Stanford. What's fascinating sometimes about that school and all the great people that have come out that have built big technology companies is how many of them were probably influenced by the philosophical focus that the school has, is deciding, is this true? Or when you listen to somebody like when you heard Jack Dorsey, he talk about how he broke it down to first principles down to like two, and his two were to do or not do, and he had to, and he basically uses his phone, and he just has a list of do or don't do, and just reviews that list. But what's interesting, or Peter Thiel's, where he talks about the principles of protecting a monopoly, and he has it down to competition is bad and domination is good. But it was just interesting to see if there's any first principle thinking where you're running into founders that have a core beliefs and core principles that are down to just such a root level that they can't be reduced any further down. Love any thoughts anybody up on stage like Ed or Sheel have, because I know they talk about it in those circles that they're hanging out with. I don't know if they're going to let us know the secrets though. I'm done speaking.
Maybe I'm not cool enough. I I'm not in those circles, so I don't know what they're talking about. I'd say in general, I think you did a good job of explaining first principles thinking, which is like a basic principle that you can't get any further to deduce from. Um, and I think it's just a way to say think like a scientist, use a scientific method, which is certainly the way that we encourage people to think. But I don't have anything brilliant to say here.
Come on, Ed, you got something for us? Ed?
It's such a big topic and probably better for another room. But in some ways, it might be the inverse of the innovator's dilemma, where existing incumbents are so optimized around their existing customers that a lot of people assume those are facts that can't be changed. And if you go back to the beginning and really try to understand kind of the core basics of what's going on in the interaction in the marketplace, you might find a different route to a different solution that actually reaches a new possibilities that weren't obvious before. So just another way of kind of reframing the opportunity, reframing the discussion to maybe discover something that other people are missing.
Okay, great. Hopefully we address that a little bit. It might be worth having another session and really digging into that. Pooja, is that how you pronounce your name? Pooja? Do you have a question for Sheel or the panel, or a thought on this topic? No, okay, Michelle. I know you haven't had a chance to
Wait,
really.
can you hear me okay?
Oh, here we
Hello?
go. She's back.
I'm
She's back.
sorry. I'm sorry. I was muted. So first, thank you guys for this talk. And please forgive me. I have COVID and I am not feeling that great, but this conversation is awesome. And I wanted to get your advice. I am raising money for a feature film that I wrote and I'm going to direct. And my story is that in 2018, I created a web series called Geeta's Guide to Moving On. And it garnered interest from a studio that wanted to make an offer on it. Didn't come together. Then I kind of went into a development process in the Hollywood system, and that kind of took years. Didn't really come together. Um,
Sorry, you're breaking up. For the Wi-Fi or something working, or is it our Wi-Fi here?
or you can raise the rest through equity financing. That's my responsibility. I have verbal commitments of 200,000, and I would love advice on how to raise the rest.
Okay, well, I know we have an expert here. Jeff has been in that business before. So if you heard that, Jeff, take a shot at it.
I mean, it broke up quite a bit, so I didn't really hear the whole story, but I caught a little bit of equity financing pieces, and I know that there have been a number of entertainment projects that have, used crowdfunding to get the ball rolling. But it's been a number of years since I was actively involved in the film industry, so I didn't really hear exactly what the question was. Sorry.
But I wonder if Kickstarter, is that something you've seen used for raising money for movies like that,
There have been
Jeff?
numbers. There have been a number of projects, certainly to get like a pilot done, or even a number of film projects have funded like an extended trailer, maybe a 5 to 7 or 10 minute, trailer for the film, and then they've gone on to try to use that to raise additional funding or get the interest of a studio or streaming service. So certainly there are a lot of entertainment projects at various levels using crowdfunding. Um, to get money. I'm not sure about the equity funding as much as just the traditional, Kickstarter, Indiegogo crowdfunding.
Okay, I don't know if we want to do Kickstarter. The seed money will be 500,000, so that's a little bit more than what a traditional Kickstarter, and the total budget we're aiming to raise is 3 to 5 million.
Yeah, I mean, there have been projects funded through crowdfunding, in excess of that amount. It really
Okay.
just depends. It really just depends on you know, what kind of interest you can generate and the belief and the following you can have.
Okay, I like that idea. Okay, I'll look into that. Thank you. I appreciate that.
Yeah, I know
Hey,
Jenny Casson has a show on Wednesdays at 7 p.m. Eastern on Startup Club, and she dedicates that show to. She's a lawyer out of California and talks about all those crowdfundings and all those different types of offerings. So you should definitely go to that show and get on stage and ask her some questions and see what her thoughts are. Michelle?
Oh, thank you. I'll look into that. Okay, thank you so much.
I would also say you might look at what Mila and Ashton Kuster are doing. They actually are doing a project that's called Stoner Cats. They do a DAO. So there are people out there doing it, but I think, to Jeff's point, it's kind of a new way to do things. So if I were you, I'd just start really looking at who is successful in the space and what they're doing.
Okay,
And Stoner Cats is one that gets a lot of attention.
awesome. Thank you so much. I'll definitely look into that. Thank you.
Great.
Hey, I have a
Pierre?
question.
Okay, sorry, Michelle.
Yeah, I have another question for Shill. Why we have him here? So Shil, like, this all sounds, rightfully so, rather complex. And they're big ideas and really big projects. And you need, obviously, like you said, it has to be in your industry and really has to strike a chord with you. So let's just say, we have members here that have what they do believe is a great idea in your space or another space. What would you recommend to them? Because I dare to say that the vast majority of folks don't have this experience putting together this deck and pitching. And that experience could take years to develop. Um, like, who would you suggest that they might even seek to network with or to get coaching or consulting with? Like, what could help them actually get to the point where they could even have a productive conversation with somebody like yourself in your company? You're on mute.
Oops. I think there are a bunch of resources on the internet. I would say Y Combinator. Just go to their website. They have a bunch of great resources. Another place to turn to is First Round Capital has something called the First Round Review, which is like a blog that has just a tremendous amount of resources on how to get started. So I would go there and actually, like, let me look up. There's one other that I wanted to highlight that I'm going to look up and tell you.
While you're looking that up, Lil actually did Y Combinator as well, and that's she's the one who did Zendu, and that's one of the companies I invested in as well.
Cool. How are they doing?
Zendu's doing very well. I don't know if you know the story, but she did get a lot out of it. I know I talked about Silicon Valley disease, but the reality is she got a huge amount out of that process. And so that's something that if you are thinking about raising money, connecting with these incubators, accelerators, innovation centers, that can be a starting point.
Yeah, that's great. Um, the thing I was looking for is called Founder Library, founderlibrary.com. Lots of great advice on there. And, they realize they don't have to reinvent the wheel, so they've bookmarked other great advice too.
Yeah, I think that's great advice. And we can put that in our blog post for the members who are following. So remember, to go to the website, www.startup.club, and join our email list so that you get email alerts for very cool, informative speakers like Shill has been today. Also, you'll be able to hear recordings as well as blog posts. So, Shill, I'm glad you bring that up because it's one thing that we have heard consistently, I guess I should say, is, if you do have an interest and you're not quite there yet, join an incubator and find one that's in your industry. They'll have connections with investors, maybe VCs, maybe, angel investors, to give you not only advice, but if it's an idea that resonates with them, they can help take you through the process. So it's definitely worth doing. So thank you for bringing that up and pointing us to a few specific examples.
Absolutely.
Yeah, great. Pierre, we have you on stage here. Do you have a question or a thought about seed funding?
Hi, everyone. Good afternoon. I just had a quick question. I guess I'm looking. I guess the question I'm going to ask is, at all times when people are doing a startup, they are starting fresh. But what caught my attention earlier was a discussion about scale. And if you're an established business that's been around and you're looking to maybe, and you've been private for a while, but you may be looking to scale maybe a new product that might take you into a new industry, does that prevent you necessarily from being considered for VC if you've been around for a while? I'll say from my end, I run a small business. I work with small businesses on their analytics for 13 years, and I am actually thinking about a couple of things for in terms of products, which I think would be great. But I think I have experience which may also help that product out at the very beginning, at least be or at least give some competitive advantage. But I'm not sure that, given that I've been around for 13 years, that might be seen as maybe not too old, but maybe not quite the area that VC would look at. So I was wondering if you had any thoughts on that for people who may be a little bit more established, but they know that they may have to come up with a product that would scale that needs to scale to kind of get into a different market or play a different market. My question makes sense, and thanks for your answers.
Um, I I think I understand. So is the basically like you've been in business for a while and now want to scale. I would say VC is not really built for that. Most of the folks that most of the folks that um, use venture capital are starting a new business. It tends to not be existing businesses that have been around for a very long time. But it depends on the numbers. It could be there are bootstrap businesses that have been around for a long time that raise venture capital to get to that next level, but they tend to have very significant revenues and be large companies when they raise rounds. And it's not from people like me; it's from people with a lot more money than me.
There's probably a negative bias if you've been around for a while, right? Because the thought is, by the investor standpoint, is okay. This is pretty much a lifestyle business. It's a static growth. It's there's something called the Rule of 40. I don't know if you follow that one. I've followed that one for a while, and we always look at the Rule of 40, which is what's the growth rate plus the EBITDA or earnings, and if it exceeds 40, then I'm okay with that. And actually, they were
Yep.
talking about that on CNBC about the company Snow. If you're
Yeah.
familiar with that, with Frank Slootman.
Yeah.
Snowflake.
And
Snowflake.
Snowflake, yeah, I know the symbol snow, right? And Snowflake had about an 80% growth rate, but yet they had negative earnings because we're now dealing with unusual times. It was getting hammered in the stock market. And even though it exceeded the rule of 40, is the rule of 40 something they use at all in your world, Sheel?
Um, Not at the stage that I invest, but absolutely it is a thing that venture capitalists use in the later stages. So yeah, you're totally right. That is a metric people use.
Okay. Well, great. Well, we're winding down. We're winding down the show right now. Any last thoughts, Sheil? Any last pieces of advice or wisdom you can share with our startups that want to raise some seed capital?
No, this has been great. Really, thank you for having me on. Great to reconnect with you guys, Colin, Jeff, and Ed, and then meet the rest of you.
All right. So then I'm going to ask you another question because that wasn't the best end. Rejection. It's part of the process, right? What do you
Yeah.
say to those
Oh yeah.
people who keep getting rejected over and over again?
Keep at it. I've been rejected so many times in my life, and I think the most important thing is to just get back up and don't even think about rejection. So that's been my motto always, and it has served me well.
All right, that's great. And again, please follow the mailing list because if you wouldn't know if Shield's coming on if you weren't on that mailing list, it's at startup.club. And
Thanks, everyone.
we're also trying to do giveaways as well. See you later, Shield. We're trying to do giveaways as well, and if you're on the email list, you can benefit from that. Next week, we're talking about raising money again, but we're going into a really weird world here. We're talking about tokenizing real estate. And there's a project down here in Miami. There's a gentleman who's coming on, and Jenny Caston's going to be coming on as well. She's the lady I mentioned earlier, the lawyer from California. But this gentleman's working on a project to tokenize a Miami condo building in Wynwood. And I began to talk to him about my real estate business and could we tokenize that? What an interesting concept, from BC to tokenization. We're going to try to uncover it all here on the Serial Entrepreneur Club Hour. Again, check out the podcast on your favorite channel. Thank you very much. Ed, really nice to see you and everyone on stage. Stephen and Michele and Jeff, have a good day. Colin C. Campbell, complete.
Thank you so much. Great room.
Thanks, everyone.